Thank you for that introduction. Essentially, what I want to cover with you today is really just where I see us being in mining tax today and what the developments are, and also what we think will be coming your way in the near future. So essentially, if I just look at where we are, some of the cases I'd like to cover, just so that you get a perspective from our side as to how we interpret these cases and what we think is important for you and what we see SARS doing about those cases. And then some of the activity we're seeing from SARS in the mining area, so that again you might be aware of what's coming your way or what is maybe happening to some of your peers. And then, as I said, some of the changes that we see coming or expect. We have, as you may know, Keith Engel, who's joined us, who used to be National Director of Tax, of Tax Policy at National Treasury. And it gives us quite a good insight as to what the thinking is of where things are going to go in the near future. So if I can maybe just start off with the Arm Gold Harmony Free Gold joint venture case. Now, if you aren't mining and you haven't read this case, you maybe should. But essentially the case deals with how you deal with mining capex and also then losses in the context of a gold mine. And this for us is a very important point to remember, because in the context of gold mining, you may know that you have a specific formula at which you are taxed, which determines your tax rate. And we do believe that that gives a distinction between a gold mine and other mines as to how you may apply this case. So essentially, basically just Section 36 gives you your capital allowance deductions, so you get 100% deduction for any capex that you spend, and essentially then you have a limit on how much capex you can claim. So essentially what it does then is it says you need to take your overall mining taxable income, and that's one cap that you apply, and then there's another one which says you also apply the cap per mine. And this was one of the things that really was critical in the case that was analyzed. So, although there is a maximum that may be deducted, it doesn't basically give you entitlement to claim all your capex that you've incurred. And essentially what this means is, if you have incurred capex, and in the case of Harmony, for example, if you've incurred capex, it may still be limited by the fact that you actually have losses in other mines, and that you need to make sure that all the various caps work together. So you need to look at your overall cap on your capex, and you also need to look at what the individual mine's taxable income is, and apply your capital mining cap to that as well. The important thing, I think, that came out of this case is that your assessed loss cannot be set off against non-mining income. And in practice, a lot of us have been doing this. And that is a very critical point that came out of the case, which, whether you agree with it or not, is quite important to understand. But I'll deal with that in more detail in a moment. Sorry, let me just get the right thing going here. Here we go. So, essentially, just what I wanted to share more with you is just our observations on the judgment. One of the things that was said categorically is that the mining activities of each one of your mines is not a separate trade. Now, that's an interesting point from a point of view of, we've previously seen SARS arguing, saying that your various mines are separate trades and you cannot set losses off against the different mines. Now you start getting into a contradiction, because in the context of this case, for example, they were ring-fencing the various mines, and they were saying that you couldn't take your loss that you incurred on one mine and set it off against non-mining income. The distinction, we believe, is because this is gold mining and there's a formula that applies that talks about Section 20 and your assessed losses. In the context of a non-gold mine, we still believe that the debate may be slightly different. I think you also need to look at whether you have a loss brought forward, whether you have a loss in the current year from mining operations, and whether you have an assessed loss in your position. And what I mean by that is, if you look at the Harmony case, and the one thing to remember is Harmony had a loss in one